everyone, my name is Elise Heigl, and today with me I'm joined by Nathan Squires and Bo Fraley, and we'll be presenting about Saratoga Resources, whose ticker symbol is SARA. So for our agenda today, we are going through an overview of the company, and then we're going to look into what triggered their bankruptcy, and then we'll be moving into their prices versus their costs of producing oil and what they get paid for a price for oil. And then we'll be moving into their production and how it's declined, followed by their reserves. And then finally, we'll be looking at financial ratios that we pulled from their 10K, and then we'll be wrapping up. And here's Bo Fraley.
So Saratoga Resources was founded in 1990, and they have offices in Houston and in Covington, Louisiana. They're a complete domestic company, having most of their assets in the Gulf of Mexico and Louisiana area. They use the successful efforts methods, which we'll be able to describe a little bit why that harmed their ratios quite a bit and had some issues. They first had a bankruptcy in 2009, but they were able to kind of come back until they had to have their second bankruptcy in 2015 in June. So what caused the bankruptcy was a series of failed interest payments. They started off their first lien interest payments at the end of 2014, failing to pay that, and then the day after, they also failed to pay it to their second lien interest. So even though it had nothing to do with their ratios, strictly because they failed to make these interest payments, triggered a bunch of forbearance agreements. Each month, the interest owners basically said, okay, we'll allow you to pay us at a later date. You can pay us next month. And then they failed to pay them. And then again, the same thing happened in February and in March and in April until in June, they finally had to file for bankruptcy because they were unable to make any of those payments. The principal amount of debt outstanding, you have just over $54 million to 10% senior secured notes, and then more than double that, $125 million to the 12.5% senior secured notes. And now Nathan is going to come to talk.
Thank you. So now we see here the price of WTI crude versus the operating costs to actually extract the oil. Now I know we talked about how that's difficult to find, but they went ahead and did an estimate to find out how much it costs them to produce each barrel. So as we see at the end of September 2014, WTI was at $93, and it was still costing them $104 to extract. So obviously they're operating at a loss right there, which is not good. And then we see what happens. Price goes down in really less than a year, and then almost a year from then it goes down even more. But they're now having operating costs of $196 a barrel. Now we'll talk about why that's a lot higher. They had an impairment write-off that they had for some of their assets, which we will see. So they had $196 a barrel in 2015. The impairment expense, when you kind of break that up per barrel, was $130. So the reason for the impairment expense was related to their Grand Bay field, resulting from the continuing decline in commodity prices, which resulted in lower than expected future net cash flows at the producing field level. So we found that in their 10Q. Non-cash components of the operating expense, however, were almost 80%. So clearly it actually wasn't costing them that much cash to actually extract the oil, which is good, but still costs are a lot higher. The cash components of operating expenses per barrel did decrease by 50%. So in that last number, in September 2014, they were able to get their costs down by 50%. However, the drop in oil prices for WTI was still more than enough to make up for that. So now we're going to take a look at their production and see what exactly happened in the last year. We see that at the 2015 September 30th, which was their last 10Q, they had revenues of almost $5 million, and however, last year they were nearly triple that. So they had a 65% decrease in revenue. Then we look at their production, and we see that there's a 26% decrease in oil production. We would think that would have to do with the lowering prices, because we talked about in class how as the price goes down, there's less oil that you're willing to pump at that price. And so that's probably due to that. However, it didn't drop by that much because the company was struggling and they needed to pump. We also see the same thing in the case of their reserves. So in 2013, they had 9,000 barrels of oil, 48,000 equivalents in gas, and their present value of their reserves was 410,000. And then we see in 2014, they've now almost halved, and the present value is almost halved. So the reason for that is not really because of price, but because they extracted a significant amount of oil without adding any more reserves, which, I mean, doesn't really harm them so much in the short term, but in the long term, that's not a very good strategy. And now Lisa's going to talk about ratios.
Okay. So we took their 10K for 2014 and we calculated some ratios, most of which are liquidity ratios. And so kind of to see how much their liquidity went down from 2013 to 2014, we can look at the current ratio. So in 2013 it was 2.1, and then in 2014 it dropped all the way to 0.08, which means that they're barely making enough cash and cash equivalents to cover their current liabilities. And then their quick ratios, which is an even better estimate of liquidity, I think, actually went down from 1.95 to 0.07. So even with that price drop right there before they filed for bankruptcy, it was already not looking very good. Again, their debt to equity ratio went down significantly. It was 4.79 in 2013, and it actually went negative in 2014 to negative 1.69, which means that they had actually more liabilities than they had assets. And then their times interest earned ratio for 2013 was 0.17, which was kind of low to begin with, but this one actually went down to negative 0.49, which means that they didn't have enough to cover all of their interest. So to conclude, I think Saratoga Resources really exemplified some of those unique characteristics that we talked about for E&P activities. So obviously there's a high level of risk, and there's a long time span between when they pump the oil or find the reserves and when they actually see the benefit from it. And this can be especially hard when you find your reserves, but then you can't necessarily pump it out as quickly, and then the prices go down even more that it might be too costly to even extract it out. So it's just kind of sitting there. Also, in their 10Ks, we found that they had a 100% working interest. And this could expose the company to even more risk because they're having to cover all of the production costs to take the oil out of the ground. Also, the rapid decrease in prices really intensified the situation. We saw in a previous slide that the prices had dropped in September by almost $50 down to December, where it was hitting at $54 a barrel. So that really intensified the situation because they had not a lot of time to come up with a solution, and I really don't think they were expecting the price to drop that much. Also, it was interesting to see that their creditors, they didn't default, well they did default, but it was based on interest payments and not on any debt covenants. So maybe the creditors should have put in some debt covenants that would have maybe alerted them earlier to the possible situation where Saratoga could have been in a bad situation to pay. So that's kind of what we looked at. Due to the large and quickly decline in prices, we really don't think that any of the accounting methods really hurt Saratoga Resources. They did use the successful efforts method, which probably intensified their expenses that they had instead of the full cost method where they expanded it kind of over a period of time. However, really their issue was that they just didn't have enough cash, especially when the prices dropped so quickly as they did, that every time they pulled oil out of the ground, it was even more costly for them, and they just weren't making enough to even cover that. So that's all we have today. Thank you. Is that better?